Hey everyone, very excited to welcome Leo to the Thrive Through Connection season. Leo, I don't know if we're friends, acquaintances, longtime fans, or just pen pals online, but it's great to have you on. For those of you that don't know Leo, he's one of the co-founders of Susa Ventures, one of the preeminent early stage venture funds, and now the the GP and founder of Humba Ventures. Humba is investing in pre-seed and seed stage companies that kind of fit into deep tech and American dynamism. Think like defense, robotics, manufacturing, energy, space, like hard stuff, hard tech. Recently raised fund two from what I saw online, a $40 million fund. Think investing a quarter million to $500,000 at pre-seed and a $500,000 to $1 million at seed. Leo, welcome. By the way, I think my favorite thing is like you guys are great at marketing. Like you just say exactly what you want. Like here's what we invest in, here's our guide rails. It's in your signature. It's everywhere. I love it.
Thanks, I appreciate that. Yeah, I'm excited to chat today, Mike, and can't believe I think we initially met like 10, 12 years ago, so it's been fun to watch your journey as well. So congrats on all the success with Visible.
Yeah, I think I was doing some quick math. I looked at your LinkedIn again this morning. So you now have been an investor longer than you've been an operator.
Good.
And what's that journey been like? Like, what are the parts that you miss of operating, or what are the parts that you would miss of investing?
Yeah, it's a good question. I spent 10 years as a software engineer. I was early at a couple startups like LinkedIn and Factual. I worked at Google a little bit, which is not quite a startup when I was there. And I liked that a lot. And when I first got into venture, I thought I'd do it for a year or two, learn a little bit about super early stage companies and also how investors think, and then I'd go start my own. And at some point, I just very quickly fell in love with venture and realized like I missed building, but I think if I left venture, I'd miss venture more than I missed building. That's always what made me stick to it. And I've just, lived it more and more over time. I think on the building side, like what I miss is like literally building, right? Like
Yeah,
you write some code, you have something that works, you could show it to somebody, it's very tangible. I don't know if there's something quite like that on the VC side. What I love about the VC side that I think I'd really miss if I went back to building is like you just meet so many great people. You get to learn about so many things, especially in some of these new areas I'm focused on, like the deep tech stuff. Um, like every pitch is like an awesome learning experience, an awesome chance to meet like an expert in their field. So I think that for me is like very replaceable, and I'd really miss it if it went away.
yeah, that's awesome. So you're one of the original founders of Susa. Susa now has over $750 million. And can you talk about like the decision to create like the sub brands within like the Susa family and like in Humba in particular, which is where you're focusing all of your time?
Yeah, we thought about it. I think like one of the models we were kind of looking at is like Andreessen, and they have sub brands that are all have Andreessen in the name, right? So they have like the A16Z crypto fund, the bio fund, the core fund, the dynamism fund. And I think it's like an interesting strategy because like it's such a big firm, obviously, like they're one of the biggest VCs. But I think if you're a founder and if they didn't have these subdivisions, you'd be like, who the hell do I talk to? Right? There's like 800 partners on the website. But you're like, oh, if I'm in manufacturing, I go to the American Dynamism team. If I'm building therapeutics, it's bio. So I think it's like a very good funneling mechanism for like to make sure that both the partners and the founders are like, talking to the right people. Um, and I think also it lets you build like a brand in those different sectors, right? So it's like if Andreessen had like a single fund and they had like whatever 300 companies a year they invest in and like five are deep tech, it's hard to go out and be like, hey, we're a deep tech fund, right? But if they have a sub fund that just does deep tech, it's easy for that sub fund to go out and say that. And so that's kind of how we were thinking about doing a separate brand versus like just folding it into the core Susa fund. Felt like these are new sectors for us. We didn't really have a track record there. And I think it would be hard to go out to founders and tell them like, hey, we want to write a $2 million check and we're a deep tech fund, even though if you look at our portfolio, like that doesn't seem like it. And so the feeling was like if we start a separate fund, we could share a lot of resources. We share an office, we share an ops team, we collaborate a lot across the investing teams. But Humba really has a brand like just in deep tech and American dynamism. And like it's very clear to founders who they should talk to, like if they fall into either the Susa or Humber bucket. And then additionally, like I think like you could have different check sizes, you could have different investing committee like decision processes, and that's harder to do if you're trying to do it within a single fund.
Yeah, that's great. What about um, the kind of fund size itself? So essentially, you've been incredibly successful with Susa and some killer companies. Was that a factor of Humba being new, just having amazing restraint yourself? Because you see like larger and larger funds now, maybe fewer being formed of big ones. Like what went into the decision to have a $40 million fund too that was oversubscribed? Because it was
Yeah,
oversubscribed, at least from what I saw online.
we got a little bit oversubscribed. So I think this was like a learning from Susa, where when we started Susa, we had a hypothesis, which was we wanted to start small and we wanted to grow sort of in lockstep with our reputation.
Hmm.
And basically, the idea was like, we never want to be in a position where the fund is large. We have to write $2 million checks, but maybe we're not seen as competitive with other funds that write $2 million checks. And so every time we get to write a check like that into a company, there's probably adverse selection because all the funds that have better brands passed on it. We started out with 200K, 300K checks. That was pretty easy to do back in the early 2010s. And then as our portfolio got better, as our reputation with founders grew, second fund was like 500K checks and then $1 million checks in fund three. And now in fund five, it's more like 2 to 3 million frequently. And I think we do have a brand that is competitive at that size, but I don't think it would have been healthy or smart of us to try to do that 10 years ago, even if some LPs gave us that much money. And so the thought was similar on the Humba side. Like, I want to actually like build and earn this reputation and like have a portfolio that, over time people look at it and they're like, I want to be part of that group. And I think that's something that, just shouldn't be rushed. So the first fund was really tiny. It was like 15 million. I think we started building like a pretty good brand and reputation with founders. So fund two was 40 million. I think fund three probably be like 60 or 70. And it's kind of following along the same kind of trajectory that Susa had, where the first few funds were like 25, 50, 90, where you're growing your fund and check size, like kind of commensurate to where you are in the market versus trying to really go ahead of your skis and then paying for it later.
Such good sage advice for anyone listening. I love that. Want to switch gears, kind of the founder side as we're working with 5,000 founders every month now. Fundraising is always on everyone's mind. Um, and so one of the things I love from your site, it says the rate at which companies we work with to raise follow-on funds is like 70% that you're working with at Humba and Susa. Your math is like this is 2x the industry average, like 30 to 35%. So like why is that? Like why are you guys spending presumably 2x the amount of time as the industry average in supporting the companies with follow-on funding?
Yeah, I'd say there's a couple of factors that go in here. By far, the biggest one is the founders and companies themselves, right? So we try to be good at picking. And so I'd say like, you know, of that 70% follow on rate, probably like 60 or 65% of the credit should go to the founders and the company and the progress. I think we try to help with the other 5 or 10%. I think the two things that help there, one, we can help with like process and intros and all of that, right? So um, we'll help you with like pitch deck prep and pitch practice because the Susa and Humba team have like there's a bunch of investors across the two funds. The combined follow-on investor network's large, so we can often suggest funds that you knew you wanted to talk to, but also maybe some good ones that you hadn't heard of. So I think that's like kind of the table stakes piece that we've been good at over the years. I think the other part that I didn't appreciate when we started, but I do now, is like there is sort of a network effect or like a compounding effect of having a good follow-on rate and having like being in good companies in the early days. Because what happens now is like because people see that we generally invest in good seed stage companies and that those companies often go on to raise and be successful. Like when we send intro offers and requests to Series A funds, they're more likely to take them, or like they're more likely to like take a second look even if they weren't going to in the first place, right? And like we can back channel better with founders. Like so, I think there's just all these things that compound from having that better hit rate in the early days. I think it leads to an even better hit rate in the current era.
Yeah. Okay. What's the biggest shift that you're seeing in that case from founders when they move from, they're pitching you initially, call it a pre-seed or seed stage, to now you're helping assist at the Series A and like what's that shift in the pitch? Like what is that shift that I need to make and how do I need to adapt as a founder?
Yeah, I think the biggest thing is like you just need data and evidence about you making great progress. Like I think with a seed round or a pre-seed, you can usually, one is you can kind of raise up more off of like team and vibes and idea, right? Which is like we're a great team, we have this good idea, no one else is doing it. Like here's our approach, and people invest just off of that if the team is compelling enough and the idea is compelling enough. And I think when you get to Series A and somebody's writing like a 10 or $20 million check, they're really looking at like, okay, like the idea was good. What have you actually done with like the $4 million you raised 2 years ago? And they're tracking your progress relative to your idea, but also relative to like, well what do other teams with $4 million get done? Right. And so I think now they're looking much more at evidence versus just the story. And so you need really good evidence. I think the other thing too is like you need much more conviction from the investors, because for a seed round, like right, you might have a lead that does 3 out of 4 million. You could also probably stitch it together from a bunch of like 250K, 500K checks. And so like there's a lot of different avenues to go. With a series A, like you can't really stitch together 15 million with like 200K checks. It doesn't scale well. So you're really looking for somebody that like has enough conviction where they make maybe 1 or 2 investments a year as a partner. And they're like, this is the one company I'm going to put $10 million into this year. And that's just like a way different bar than somebody that invests maybe like in 10 or 20 companies a year.
Yeah. Wow. One company a year. That's pretty wild. Like thinking about that, like
Yeah.
years of how you're gonna find like this is my one shot. Anything that you've seen, maybe I'm getting forward ahead of myself a little bit, but like what about like the relationship building that goes into that, right? Like if I'm investing in one company a year and I'm writing a $10 million check, when does that relationship start? Is that like 12 months before? Is that a year? Like where is that in the cycle?
Yeah. So I guess first I'd say like I think building these relationships early is great. Um, it's like not necessary or sufficient, but it helps your conversion rate. And what I mean by that is like you could meet someone the day you start raising, and they'll, if the company is compelling enough, they'll just invest very quickly anyways. Or you could get to know someone for 2 years and then they still don't invest. Like so, either of those things can happen. But I think your chance of getting investment rises as you get to know somebody, especially if you make good progress between meetings with them. Um, I would say like you probably want people to know you at least like maybe 2 months before a raise or more, right? If you're meeting somebody 2 weeks before you raise, it's not really building a relationship. It's more of just like a pre-rep, a pre-raise like qualification meeting or something.
Yeah.
But if somebody met you, let's say 2 or 3 months ago, and then you're raising today and you send them your progress, and it's like, again, it's sort of that execution data piece, right? Where they're looking back at like, okay, here's where you were 2 or 3 months ago. I can see you made a bunch of progress. Like it's very impressive for 3 months. Like, maybe they're going to be more likely to engage. I think if you've been able to do that a couple of times over a year, maybe a year and a half, that's even more powerful, right? Which is like you met somebody, 15 months ago, you met them again 9 months ago, you had made a lot of progress. You met them again 3 months ago, you made a lot of progress. Now you're raising. They're like, wow, like I could just see the trajectory here is really awesome. Like they might get really excited, even if it's maybe not a category they're usually excited about, or like a space they invest in, or that kind of thing.
Yeah.
So yeah, I think at least a few months is great.
Well, what role do you think investor updates can play in that? So a little self-serving, but I'm going to ask the question because we have a template, and I've seen the Code ABC posts you've done in the past. Like, what role do investor? I think you had a recent post like they're basically customer success tool, which I totally agree with. I say that all the time. Um, what role do those play in helping building the relationship with those future funders?
Yeah, it's a great question. I would say like I think one is it is a good customer success piece for your existing investors, but that helps you get more traction with future investors down the line, right? Because what will happen is like if I get good updates and I can see like, hey, Visible's like doubling revenue every 6 months. Every time I'm talking to my Series A friends and they're like, what company should I be looking at? They're like, well, Mike at Visible, like they're doubling revenue every 6 months, right? Like they should be top of your list. If I never get an update and I never hear from you, like you can still go raise a Series A eventually. It's just going to be harder because like there's no pre-marketing, right? There's nobody like kind of building excitement about you to downstream investors. So I think that customer success piece is important. Also important if you end up needing a bridge round, right? Like, if you're like, hey, we're doing well, we wanted to check off like four milestones before the A, we've only done three, we need an extra $1 million. Like if you've never talked to your existing investors, like it's hard to get that extra million. If you've been communicative and they can see you're making good progress, like usually that million is pretty easy, right? So that's like the first piece. Um, I think the other piece is like you can use these updates to get help in areas, right? And I think I think this can be in anything. It could be like, hey, I need some help finding candidates or getting an intro to this company. It could be like, we need an expert that has, done this kind of thing. Or does anybody know, like, really, like, here's a request we had a few months ago. Somebody had like a Viva type business model.
Mhm.
And they were like, there's not a lot of companies with this business model. Does anybody know like kind of first 5, 10 salespeople from Viva that I could talk to one of them and pick their brain? And across the investor network, they ended up finding a couple of people like that, and like it was really useful with the company. But so you can get like really specific in these areas, and worst case is like nobody can help, and best case you get some help, right?
There's a total butterfly effect. Like I actually started adding on some of our larger like partners and customers to ours just because like, hey, why not? Let's just see what happens.
Yep.
And through that, I got connected to another person, and then that person referred us to like one now potentially our largest deal of all time. So there's like a real butterfly effect that happens,
Yep.
which is pretty wild when you think about it. I think a lot of founders sometimes are scared to share and be transparent about. And sometimes that's right, but like I think founders err on the side of like being too open or scared about being open, and in reality, it should probably be the other way around. Like everyone should
Yeah.
kind of know what you're up to and what you're doing and challenges. Again, it kind of depends on what you do.
Yeah. I agree. 100%.
Kind of speaking of stealth and challenges, so like you do have a higher percentage of companies just by nature of what you're doing and deep tech and stealth. Any specific challenges that come with that, and like any advice you'd give to founders or funders navigating companies that are in stealth?
Yeah, it's a good question. I'd say like on the software side, I always felt like stealth was pretty overrated. Um, I think probably even more so now with like all the AI vibe coding stuff. Like if your features are easy to clone, like people can clone them pretty easy, like quickly now. Um, I think sometimes it makes more sense on the deep tech side because, if, like you have some hard process, it takes a couple years to figure out if nobody else is thinking about it, and you can get a couple year head start. And then even if like people find out about you in 2 years, like they need 2 years to catch up, like that's a pretty good place to be. So I think stealth sometimes makes more sense for these kinds of companies. Um, I would say like stealth doesn't really hurt, I think, behind closed doors, meaning like if I need to talk to a Series A investor, like there's not really a thing as like such a thing as stealth, right? Because they'll be like, which company should I talk to? And like whether visible is stealth or not, and just be like, oh, visible is growing really well, you should talk to them. Right. And I think the founders like that versus trying to like not have any investor know what they're doing. I think what's harder is like if you ever want something public facing, then like we just can't help that much, right? Like for example, if you're like, well, we're hiring, but like we don't have a website and like we don't want people to know you invested in us, but can you help us with this hire? Well, before maybe I would have posted it on LinkedIn and Twitter and like seen what I could do on our job board. And if you say like you can't do any of that, like my help's gonna be like 90% less because like unless I know somebody in my network that would be a good hire, like I just can't help there. One thing I'll add for stealth is sometimes one downside of stealth is sometimes like investors are explaining your company on behalf of you instead of you, right? And sometimes things get lost in translation. It's almost like having like a distribution channel partner, right? Where like unless your messaging is really good, the partner often doesn't do a good job because it's like if you don't have a great explanation of your company, the partner is going to make it even worse. So it's kind of the same thing where like I definitely feel like sometimes with some of the self companies, I explain it and I'm like I feel like I'm kind of 80% getting it right, and I wish the founder just had like a message I could share, or it would be like look at this website. But when it's stealth, you kind of you take that away.
Yeah, that's great advice. Kind of moving to the direction of fundraising and fundraising support. One of the amazing items on your site, I love how specific it is, by the way, and just the minimalist design, by the way. I do love that. You see so many bloated websites these days. What is the number one mistake? You mentioned, sorry, that you'll iterate on deck content together when you're going out to help with their fundraising, pitch practice. What's like one mistake you see founders, maybe prospects coming into your potential investments? What's one mistake you see them make when they come to you and your team with their pitch deck? Maybe a few common mistakes.
Yeah, maybe let me give you two. So I think the first one is like burying the important stuff, right? So it might be like, hey, you went from like, 0 to 2 million ARR in 4 months, and then it's like slide 17 of 20, right? And if like you don't catch someone's attention in the first 16 slides, like somebody might not ever see that, right? So I think you want to be really like bold and aggressive with like the one or two most special things about your company and make sure they're pretty early in the deck. That's one piece. I think the other one is like over or under explaining things, right? So on the over explaining, like I think I see this a lot in markets, right? Because sometimes there's like an obviously big market, like oh we're building power plants, and then you see like 13 slides on why energy is important, and it's like I don't need to see 13 slides on that. Like I know energy is important, and that's like half your deck. The other side is the opposite, which is like under explaining. Right? Probably the place I see this most is team slides. And
Mm.
probably like the worst team slides I see are like a picture, a first name, and a couple logos, right? So it's like Mike, CEO, whatever, like University of Michigan, and that's all it says. And it's like you could have used like a fake picture or like a different name. It's like it doesn't communicate anything. And I think what you want people to walk away with like a really strong takeaway of, hey, this is the right team, or like our experience is perfect for this. And if you undersell it, it's just like you may as well not have a team slide because like like I could see pictures of people anywhere.
Yeah, I love that. We did a recording probably just 18 months ago, but I just it stuck with me, which is like lead with your strength, like which makes total
Yeah.
sense. And but like I think a lot of founders who are online, we're looking and it's like, here's your template for your deck, and here's what you need to do, and we kind of take that as gospel versus just like lead with your strength. Like what is your strength as a founder or as a business, which I think is kind of similar to what you said of like don't bury the lead that you just went to 2 million in ARR in 4 months. But so just lead with your strength. I love that.
Yeah.
Storytelling is gets thrown around a lot in fundraising. Does it move the needle? Like if someone's a compelling storyteller, is that something you'll help support founders on later on? With you do make an investment, you're supporting them in the next fundraise. Just kind of curious to get your thoughts on how storytelling fits into your decision making, and then how you support founders once you are an investor.
It's a good question. I would say first, as an engineer, I hate to say this, I think storytelling really matters. Like coming into VC, I really thought like, oh, it's going to be super meritocratic. Like people just look at the data and they make a decision. And like even for myself, like I find myself really swayed by good stories, and then really like like less inclined to like dig in if the story is like really bad. Even if the fundamentals are the same. So I think what I've seen is like if you're and I think people see this in their friends or in press releases. Like sometimes you have companies where they're at like 3 or 4 or 5 million ARR, which is well past where you need to be for a Series A, and then they struggle to raise a Series A, and it's not because of the business; it's because like they don't tell the story well. Like the founders like doesn't feel very compelling, even if they actually are on the execution side. And the flip side, you see the opposite, right? Which is like, oh, we're like pre-launch and we just raised like a $30 million Series A, and a lot of times it's because like the founder like just weaves that story so well. So I view it not as like a requirement. Like
Yeah.
if you're bad at storytelling, there's some level of traction. Well, you'll raise a seed round, a Series A round, a Series B round. It's just more like it won't be from the investors you are hoping for, or it won't be at the terms you're hoping for. Right. So like the better you get at storytelling, even not necessarily going from like F to A plus, but even like from F to C or like C is a big difference. Like the better you get, you get higher conversion rate on investor like meetings. And then the more investors you get, the more term sheets you get. The more term sheets you get, the better you can negotiate. So just like it pays a lot of dividends.
Yeah, I love that. Um,
Actually, maybe one thing on it
yeah.
helps with other things too, right? It helps with like sales and recruiting, right? The better you tell the story, the more excited everyone gets, not just investors.
It is kind of like a litmus test. It's like, how good are you at recruiting? Could be capital, people, customers. It all matters. Like, are they buying into that vision?
That's actually why sometimes you need so much more traction with like bad storytelling, because until you have that traction, investors are like, business seems interesting. I thought that pitch was pretty weak. And if I thought that, like, are they going to be able to sell to customers? And I could see like they have 3 sales, but maybe it's anecdotal. Like I want to see more. Right. Versus if you're really good at selling and like pitching, it's the opposite where it's like, oh, I have 3 sales and I bet you're going to get like 30 as soon as you get the capital. So like, I think it plays a really important role.
Yeah. Uh, kind of wrapping up part of the raise, or kind of the mechanics of the raise. Like, what's your advice for how and when a founder should share their deck with potential investors? Is that before the meeting, during the meeting? Like, when are you advising your founders, like when to kind of peel back certain parts of the process with potential investors?
Yeah. I think different investors have different preferences. I remember maybe it was Charles Hudson, but I remember there's like some investor I read about 10 years ago where they basically said like I hate seeing a pitch deck beforehand, before a meeting, because like I love hearing the story, I love going through it in real time. I don't want to like bias myself. I'm the other end of the extreme. Like I love always seeing a pitch deck and preparing some questions, and like I don't think that makes me like a better or worse investor. I think there's just different approaches, and I think you want to just follow the lead of the investor, right? So if they ask for a pitch deck, I'd send them one. If you're not comfortable sending the whole thing, maybe it's a little bit redacted or a teaser deck. Although I will say, like, I think people kind of overestimate how much actionable competitive info there is in a deck. Like even if I know your business grew from 100K to 400K last quarter, like it's not going to help a competitor, even if like I'm unethical and share with a competitor.
Yeah.
um, and like I'm not unethical, but like I think most investors are ethical, and then even if they're not, there's not that much in a pitch deck that will help them. And on the flip side, I think it's a pretty poor experience for an investor if they're like, "Hey, can I see your materials?" and you say no. And I've even seen people like not share materials after a meeting, which is like really frustrating, because I'm like, "Well, I met with you. I want to talk to my partner about this and share some context, and you won't let me." and then it just like kind of kills the process. And I think my analogy here is like it's like if it's a resume, right? If like you're used to seeing a resume where it's like I worked at Google, here's like the 7 things I did. I went to this university. If someone just says like, I worked at Google, and you're like, what'd you do? It's like, well, I can't tell you. Like if you interview me, then I'll tell you, but others I won't. You might just be like, man, like forget this. Like there's a lot of other good candidates. Like I'll go talk to them instead. Right. And I think it's the same with sending decks.
Well, what is the just out of morbid curiosity, what is the rationale of not even wanting to send content to you after we've already met and reviewed it together?
Of not sending content.
Yeah, well, why do you think founders are doing that? Like, why are they not sending the
So of course
start
I
time?
see it really rarely. I see it maybe
Okay.
like 3 times a year. So it's
Okay.
definitely like an outlier versus a norm. Usually it's paranoia about like, oh, the space is competitive, or we think we have like a real edge of an approach. And I think usually that's underestimated, or sorry, usually it's overestimated. In that I've seen founders that are like, oh, this is like a super unique idea. I'm just like, I'm not comfortable sharing my deck with people, but I'll walk you through it. And I'll meet the founder and I'm like, well, I've seen like 6 other companies kind of like this in the last 2 years. And, like maybe that founder is really good at execution or they have like a slightly better approach, but it's rare to find someone that won't share a deck because they think their idea is unique. And it really is like a unique idea that nobody else has even thought of.
Yeah. Okay. Cool. Um, if you're cool with it, I would love to kind of switch over and kind of talk about the investor LP side now for the kind of the other half of
Sure.
our audience. Just as I know we got a little bit of time coming up here. So Susa, you mentioned, started out with the small funds and getting larger and larger and larger. I think now 7 funds in total, maybe from what I saw online and Humba. Um, how has that evolved? You mentioned the kind of the fund size and strategy from Fund One in 2013 to now Funds Two being raised at the end of 2024 for Humba. How is that? I mean, you've seen a lot now. The 7 fund plus fundraisers. How has that changed? I guess like, and has the strategy changed at all?
Yeah. Yeah. I think like probably the biggest shift is like we just spend a lot more time with institutional investors now that are writing multi-million-dollar checks or sometimes like, 8-figure checks. Um, when we started, we pitched a lot of individuals, like in high net worth folks and, like ex-colleagues and people like that. And also we pitched some institutions for Fund One and Susa, and like it was too early for all of them. And I think kind of by accident, it was good that we talked to them because the relationship building, similar with
Yeah.
building with the Series A investors, it led to like one of them actually coming in and like anchoring our second fund. And I think if we had just met them at the beginning of our second fund fundraise, they probably wouldn't have invested without that history. So but like the first fund was almost all individuals and like small family offices. Um, I think the group we had the most luck with is probably investors from other sectors, right? So like hedge fund managers, real estate investors, public markets investors, because a lot of them like they understand investing, they understand the value of diversification, they want exposure to VC and startups, but they don't have personal access. And so for them, it's like that was like an interesting pitch to be like, hey, here's like a VC fund that's promising, and you could like put some money in there, diversify into like a the VC asset class. But it was mostly, like I said, mostly individuals, mostly smaller checks. Fund Two started shifting a little more institutional, and then I think since Fund Three, it's been mostly institutional. Um, that's on the Susa side. The Humba side's a little bit more of like a weird story. So the first fund was like a pilot experiment fund that was 15 million, and we pulled half of it out of Susa's fourth fund.
Okay.
So it pulled 7.5 out of Susa four, and then half was matched by an LP of ours that we'd known for a long time called Sindana, which is like a great seed fund of funds. And so that was the first fund. And then for the second fund, it ended up being a lot more institutional than Susa did, just because I had known a lot of these institutions in Susa for like, 5, 6, 7 years. And so a number of them came into Humba too when we were fundraising.
What about macro? I mean, you've had a great track record and great run over the last decade. Did you read online, some of the headwinds investors are facing raising subsequent funds? Did you feel any of that at all? It was oversubscribed, so maybe not, but did it take longer or was the level of diligence higher? Did anything really, any of the more macro recent headwinds play a role in the recent fundraising?
Yeah, so for context, I raised this in like late 2023, early 2024 for the current Humba fund. I'd say like it took a little bit longer than I thought. It took 9 months. I thought it might take like 4, 5, 6. But to be honest, I also like didn't know what to expect. I could see it going either way because I could see it being like, oh, this is just like a small extension of Susa. All the LPs like they'd all back you really quickly. Maybe it's a 1 month fundraise. I could see it going the other way, which is like totally new category. You guys have never invested here. It's basically a first time fund. So like maybe it's a year long fundraise and it ended up being somewhere in the middle. Um, but I think in general, like one thing I noticed is like in 2021, when we raised our previous set of funds, that was by far the fastest fundraise we've ever had, just because I think it was like right after COVID started, but like maybe a year after. And I think in the first few months after COVID, everybody was trying to figure out how to move from in person to Zoom. But like a year later, people had figured it out. And then I think the Zoomification of all these processes made them really fast because you could have like, there wasn't a lot of travel. You could just have, 3, 4 meetings over a month and someone to decide. Um, I think when I raised for Humba 2 about a year ago, it felt like things had slowed down a little bit more again. Like there's a lot more in person, a lot more of like, hey, it's a month between meetings instead of a week. And so there are a lot of processes where people said yes, but it took like, 3, 4, 5, 6 months to get there.
Interesting. We talked about this earlier. You started your career as an engineer, over a decade as an operator, um, and kind of switched to investor as maybe a side project you said to start. And now it's your full time gig, and you're on your ninth fund basically, between the two. What advice would you give someone who is just getting started today, maybe with someone similar to yourself, with no real investing experience that wants to go and create their first fund?
It's a good question. There's a lot of roads here. I think one is you could try to just create a fund. It's definitely hard to do. Um, I think you need something that like really stands out if you're doing that without venture experience, because one thing I've grown to appreciate that's like the difference between fundraising for companies and funds is for companies, there's a lot of potential exit opportunities and like a lot of potential ways to underwrite it, right? It might be like, hey, like Mike, I don't even know what you're going to build. I think you're amazing. Like I would back you and I think you'll figure it out. And if you don't, like someone will hire you or something, right? Like, okay, I might, like there's a lot of ways to underwrite that. For a fund, it's literally like, do I think you can pick well and get good like deal flow or not? And if there's no evidence of that, like there's very little downside to just waiting until you raise your fund 2 or fund 3. And so most people, again, with no evidence, they'll just wait till fund 2 or fund 3. So like you kind of want there to be evidence, right? Which is maybe you've done some angel investing for a few years and those companies are looking good. That's like one approach. Maybe you were like an associate or principal at some good fund and like led some good deals. That's another approach. Um, Maybe you're like a world-class expert on something. And so it's unclear if you can pick investments, but you just get amazing deal flow because, like for example, you're a pricing expert and everybody wants you on their cap table because they all want your help. So like there's different angles. I would say if you're going to start a fund and you've never invested it before, probably the easiest thing is to go join a fund for a couple of years first. But there's people that have done it without that.
Yeah, great. You mentioned something I wanted to pull on, which is like the what's similar and what's different about raising from LPs, as a VC versus me raising money as a founder from a GP. And has that, you've gone through that dynamic quite a bit now on both sides, has that changed your just your whole psyche towards it, like any more empathetic? I know you've always been empathetic towards founders on their fundraising journey, but like anything you could pull away from that experience now that you've gone through it quite a few times?
Um, I mean, first, I think for like 10 years now, I've been telling the same lame joke, which is we try to have empathy for founders, but the empathy really peaks every 3 years or so because that's how it is. Um, yeah, I mean, I think the biggest difference is, like I said, like I think LPs have very little FOMO, right? Because if you're pitching me, like if you have a unique idea, right? Like you're pitching me Visible, and like I've never seen anything like this. I'm a seed investor. You're raising your seed round. There's a bit of FOMO there, right? Which is like you're raising a round now. If I don't invest now, like the next round's too late for me, and then you guys are unique, so I may never be able to invest in anything like this again. It's very different if you're a fund, right? Because you're like, oh, we're B2B SaaS fund or robotics fund. It's like, well, there's like 100 others out there like that. And then so like it doesn't hurt me too much to wait a couple of years or to invest in someone else. And then if I do wait a couple of years, there's a really good chance that in a couple of years you'd still want me to invest, right? And so I think the FOMO is not there. I think especially for like the checks that are bigger, the processes are really long, right? So like a process with a seed fund might be, for a founder pitching a seed fund might be a couple weeks or a month typically. With an LP, it's often like 3, 4, 5, 6 months, and there's not really a way to accelerate it, right? Because they're just like, I'm busy, I'll meet with you in a month, and if you're closed, like you're closed, and so there's like very little you could do that. um, and so occasionally like people try some pressure tactics or something, but it usually just doesn't work. Um, I think the biggest thing that does help here is just relationship building. So one thing I've started doing with Humba is like I send like a quarterly LP update. I haven't done this yet, but I've been meaning to like anonymize them a little bit to take out some of the like more
Mhm.
confidential company stuff, and then the plan's to like share those with some of the LPs that got close last time but didn't quite get there. Um, I think trying to put in FaceTime again, trying to give people updates every once in a while. I think that stuff pays dividends because LPs really value relationships because they want to see that you're doing what you said you would, that you're like, your performance is pretty good, that like you're not doing anything crazy. And so a lot of that just more of a time and relationship thing versus a point in time pitch.
Yeah. Not on our brief that we did earlier, but I'm curious, like, how have you seen like the secondary market evolve with like the liquidity that's really not happening? Have you seen that all at Humba yet, or just kind of any general thoughts as we wrap up around like liquidity, LPs looking for liquidity, kind of what's happening in the secondary market?
Um, I haven't seen it much on the Humba side because Humba being 3.5 years old, like we have Series B companies, but we don't have any like Series D or E companies, so it's just too young. On the Susa side, I'd say one, we definitely get hit up a lot more by secondaries brokers with like buyer interest. Starting to see a lot more like experiments or like types of funds too of buying buying LPs out, buying like a stake in the fund to give LPs some liquidity. It's like a lot of different mechanisms starting to pop up because I think people see this liquidity gap. But yeah, it does seem like the secondaries market's driving a lot of realized value these days. This would be more on the Susa side than the Humba side, but it's
Yeah,
definitely something we're watching carefully.
yeah. Uh, One last question that we're asking everyone that we talked to this year. What's one professional relationship that's going to change the trajectory of your life or your professional life?
Yeah, it's a great question. I think probably everyone says this. Like, there's just so many relationships to be grateful for. Maybe one I'll call out is I mentioned Sedona. They're like a very good seed fund of funds. I'd argue, and I think a lot of people argue, they basically created the category because they started like 13, 14 years ago. Until then, you had fund of funds that would invest in venture, but they always picked the big funds because their goal was like, how do I deploy $20 million, $40 million into a single fund or $100 million? And like it really wasn't easy for like seed fund managers because you're like, well, I'm raising a $25 million fund. Your minimum check size is 40. Like, I guess, I can't go to fund of funds. And so now they saw that gap and they started investing and they invested in a lot of great funds over the years. Like, I think they're like on Root and on Cork and Forerunner and a bunch of others. And so we started working with them with Susa 2 with a small like position. Then they did a core check on Susa 3. And then I would say like they were almost like a co-founder of Humba because I think it was an experiment fund and they trusted enough to like double the size to make it a bit more meaningful so that we could write like checks that founders cared about. And then they anchored the second Humba fund. And so I think that they've just been like an amazing partner in a sea of LPs we're grateful for. Like I think that's something we're especially grateful to them for.
Very cool. If the founder thinks they're a great fit for either Humba or Susa, like what's the best way to get on your radar?
Yeah, I'm Leo at humbaventures.com. Also Leo at susaventures.com, but they go to the same place. I mostly focus on the Humba side these days. But if there's something that, is a fit for Susa, like I can share it with the Susa teammates as well.
Yeah, I highly recommend Leo for anyone listening. Anytime I send him something interesting, I always get an incredibly thoughtful response back. So that's not the expectation I'm setting, by the way, but I just maybe passed that. So thanks so much for joining me today.
Thanks, Mike.